Okay, hello everyone. Welcome to the Syndication Attorneys free monthly podcast, Raise Capital Legally podcast and YouTube channel, where we talk about topics of interest to real estate syndicators and fund managers with an opportunity for live questions and answers before we sign off. I'm Krisha Young, co-host and business development director, and this is attorney Kim Lisa Taylor, founder of syndicationattorneys.com. Before we get started, please note that the audio and video from this event will be posted on our podcast platform, YouTube channel, website, and social media, and will be made available to the public. You can ask questions at the end of the broadcast by raising your hand or typing it in the Q&A. The information discussed during this event is of a general educational nature and should not be construed as legal advice. All right, Kim, go ahead, take it away.
All right. Okay. So today our impromptu topic is 10 more eye-opening answers know about capital raising for real estate, because the last topic that Krisha and I did was 10 eye-opening answers you need to know about raising capital for real estate. So this is part 2. And we love the fact that, we talked about it from our perspective, having dealt with a lot of clients that have been successful, some that haven't been unsuccessful, but now we're talking to somebody who actually does it. So this is a rare treat for us. So in this insightful episode, Syndication Attorneys founder Kim Lisa Taylor, that's me, and our business development director, Krisha Young, will interview Jeannie Orlowski, a longtime key member and coach for RE Mentor, which is a renowned multifamily real estate training company. Whether you're just starting out or you're looking to scale your real estate portfolio, understanding how to secure the right capital is critical. We're going to explore Jeannie's most effective strategies for raising capital and the key financial metrics that investors want to know. We're going to cover the most common questions Jeannie gets from her coaching students about raising capital. So whether you're navigating your first deal or refining your capital raising strategy, this episode will provide even more eye-opening answers you need to succeed in funding your real estate projects. So there you go.
Exciting.
Yeah. So Jeannie, you tell us a little bit about you, how you got started with Dave, how your position has evolved over time and what you do now.
So my position with Dave has been ever evolving over the years. I started with Dave in 1998. I was a real estate agent and notary public, which he very much needed because he was selling deals, small multifamily deals everywhere. And he needed somebody that had a notary, and I did. But it started actually before that. My daughter was 13. She wanted a job. My brother and Dave had been friends since childhood, but Dave's 13 years younger than I am, and my brother's 14 years younger than I am. So they were hellions around the town, right? And so that's how this all started. My brother says, I'll get her a job. And he walks in with these letters that needed to have Dave's name put on them, signed, and a list of addresses and envelopes. And she would make up the return address, the envelopes, fold them up, put them in the envelope, seal them, put a stamp on them, and keep them in order by zip code. So this went on for about 6 months every single week. And she would get a check for like $20 a week, which was, for a 13-year-old, that was pretty good. So unbeknownst to me, my brother couldn't pick them up one week, and Dave needed his letters, so I drove them there. And the minute he opened the door, he said, come to work for me. I said, I do not do these letters. He says, oh, I know your daughter does. Here's her check. And he says, give me one night. And I'm like, I am like really busy. I can't. And he says, promise me one night. And I said, okay, Monday night, I'll be here Monday night, 6 to 9, that's it. And he was so convincing, that guy. So I ended up starting to work for him at night as a real estate agent. And then on Saturdays, if he had a listing, he did not like to do his open houses. So I did them. And we used to split the commissions. And we got along so famously that he one day said to me, I hope you quit your day job and come to me, work for me full time. I said, you cannot afford me. He said, try me, show me your pay stub, which I did. And he says, I'll match it plus. And I'm like, okay. So I quit my job, which I had been at for many, many years, and went to work for him and worked on top of his house in his converted attic. And we created our mentor, and something has just arisen. We went from 330 students to 590,000 students. So we did something. We did
Holy moly.
together.
Hey, that's an insane amount of people. And, I've been gone to many, many, many RE Mentor events over the years. Some of you know that I co-teach the RE Mentor Private Money Bootcamp, by the way, just a little plug here. We have one coming up
In 2 weeks.
let's see, dates on that are October 10th, 11th, 12th, and 13th. So in Atlanta.
Mhm.
So if any of you want to get a deep dive into capital raising and the legalities of it, the deal structures, and also the practical side of it, that is a really great place for you to go, because I have several many hours on the stage. Jeannie used to come to these events, but Bob Bowman, some of you know Bob Bowman, he's the other teacher there. He also has raised a lot of capital, so he teaches the practical side of things. I teach the legal structures and the securities compliance, but it's a great way to come away with confidence, knowing that you know how to structure your deals right, you know how to split money with their investors, you know what all this terminology means, and you can start talking more knowledgeably and more confidently about it to your investors. And that's the whole point of that program. So I highly, highly recommend it. Great time, a great way to kind of, just propel yourself forward.
Yeah, and it's such a focused, concentrated classroom too, and everybody's like-minded and on the same sort of mission and really there to learn and to grow. It's a great room to be in for sure.
Yeah.
Yeah,
And a
it's
great
nice to know that you have somebody that you can go to and say, is this legal? Can I do that? So it's really a good thing. Bob Bowman is more of the animated side of it, whereas Kim is more this is what you have to do to keep yourself out of jail. So it's a good combination together.
Yeah, and I promise it's not boring.
No, not
No.
at all.
I love that story, Jeannie. And also, like, how empowering too, just to walk in there and be like, you can't afford me. Like, I love that.
But you know what? I looked upon him like he was my brother, because my brother and him were basically the same age. So, and that's how I treat him today, even though I love him to death like a brother. I know he's my boss, but if he does something that is just not becoming a boss, I tell him.
So some of you are asking for more information about the Private Money Bootcamp. I'm just going to put in the chat to everyone who is on the call that here's the link to the RE Mentor live events. And I just want to point out there that there's several different events that have a really, what I love about RE Mentor is, and again, I started out in their coaching program. I took a bunch of these classes, so I can tell you, that the students that come through these classes really seem to do well. They end up doing, bigger deals and more deals, and, progressing and growing their portfolio. And so I think it's just really worthwhile to consider any of these if you can. The Multifamily Millions is how I started. This is a live 3-day event. And they have them like 3 times a month in different locations.
Yeah. Pretty soon, 4 times. We have 2 teams out now.
Wow. Okay. I wondered about that. I was thinking, boy, that's a lot of,
Mhm.
yeah. So if you look at their Multifamily Millions, if you want to know what to buy, what not to buy, what to avoid, what things to look for, and to actually learn in the class how to analyze deals, That's the multifamily millions. That's where I learned that stuff. So when you're at that event page, go check those out, see if there's one near you that you can possibly go to. And if there isn't this time, look in a month, because there's going to be more. The immersion training, tell us a little bit about that, Jeannie.
The immersion training is really all about getting a deal and making sure you and your investors do not lose money. So it teaches you how to underwrite the deal. It teaches you how to see if the unit mix fits with the area, because if it's a very family-oriented area and you have all one-bedroom apartments or even some studios in there, it's not conducive for a growing family. So we teach you how to look for that, to see where the pitfalls might be and what you can do to, maybe add space. So if it's a very large apartment, even though it's a one bedroom, put a wall up, make it for a family. And then you'll find that you'll get more benefit out of it. You'll make more money because you can do that for others. So the immersion training is all about making sure you don't make a mistake with your numbers, with the area, because we check everything. We have a CoStar report. We check what's coming into the town, what's going out of the town, if the area is emerging, and if it's declining. I mean, you might be able to buy it, but you might not be able to sell it, which is a real handicap if you're using investors to close that deal.
Yeah, that's super critical. You always recommend the multifamily millions first, though, right?
Yes, you have to know how to get the apartment, but once you get it, you got to know how to do the numbers, how to keep your investors safe so that they don't lose any money and you don't lose any money, and it's a win-win for all.
Yeah, I like that a lot. And then you can see on this events page for RE Mentor, they have a lot of those classes as well. So, various locations around the country. So private money, unfortunately, we only do that, so we don't do that all the time.
I think it's 3 times a year.
So
we do the East Coast, West Coast, and middle of the road.
So this next one is Atlanta, 11th through 13th. There's a register now button, which will give you the information you need to be able to register, and they'll send you hotel information, all that. And then there's also a sponsorship event. And at the sponsorship event, you get to meet people who can potentially GP on deals with you. So tell us about, when does someone need a sponsor, Jeannie? What is that, and why should they consider?
So a sponsor's real responsibility is to qualify you for the mortgage and have up to 6 months liquidity of mortgage payments. That is their role. But a lot of sponsors today have been in your shoes where you haven't bought a deal and they need the sponsor to walk with them throughout the whole process. So even if you have money, but you don't have experience, your bank is going to ask you to have a sponsor. So maybe you can co-sponsor on the deal, which saves you from paying people to help you do things. But in all reality, that sponsorship event opens doorways for you that you cannot believe. So maybe you can qualify up to $2 million, but your sponsor can qualify you for $15 million. So you have more buying power. And like I said, their responsibility is 6 months liquidity of mortgage payments and to have the net worth equal to the mortgage amount. Most of them will help with everything, but that is their job.
Yeah, and they'll lend you their credibility. They're going to show the list, the lender, the list of other properties that they've sponsored, which is going to, even really strengthen your team. And then they're going to give you that mentorship because they're signing on the loan. They're taking some responsibility here. They have an, obligation to themselves to make sure that the deal is successful, and first of all, it's viable from the beginning, and second, that it's run successfully and you're getting the things done that you need to get done, and helping you overcome any challenges, because again, they're responsible for that loan. So just
every single sponsor that we have was in your shoes before they became sponsors. So sometimes it takes one deal and you can sponsor. Sometimes it takes 3 deals and then you can sponsor. Because even if you have the money and you don't have the experience, that's where you come in to join forces with a sponsor, and it makes the world go round.
Yeah. And even, you guys, the attendees may have heard about non-recourse debt and saying, well, why do I need a sponsor for non-recourse debt? Well, you still do. The lender is looking at the strength of your team and the financial strength of your team. They want that liquidity. They want to know that you have that mortgage reserve. And, personally, amongst the members of the management team, it doesn't have to be one person. I've seen lenders allow up to 4 people to
so haven't I.
It can be collective net worth, but you got to know those people, and that sometimes becomes a big impediment for people just starting out, because you've got the drive, you've got the deal, you think you can raise the money, but you don't have the net worth to do that loan. So you've got to bring somebody in, and you've got to give them a share of the management earnings. Usually, in our context, you give them a share of the management fees, you give them a share of the management profits, and for providing that service, because without them, you can't do the deal. So we call them a loan guarantor, or a mentor calls them a sponsor. It's the same exact position. And then the last event, just because I think it's so important and we're going to be there, is the Ultimate Partnering event in Nashville, Tennessee, from November 8th through 10th. And we'll be sponsoring that event, so you'll get to meet us there. So we go every year. We have every year since the beginning. We wouldn't miss it. It's really just action.
Yep.
You're going to learn a ton of stuff. You're going to meet a lot of people. It's just a really great event, and so highly recommend that you go there. You're also going to meet a lot of people who provide services to syndicators, whether it's accounting or legal, or any property management, or any other kind of service that could be relevant to your business. You're going to meet those people there, and you're going to walk away feeling like, okay, now I have all the tools I need to be able to successfully do this.
Exactly. I mean, that's the place that you're going to fill your team up, because you and your partner may have, certain parts of this business, but you need all the other little supporting parts to come together. You need somebody that's like almost an engineer mentality, who can see the numbers and see through any fluff. So you're going to meet a lot of people that you want to work with, and each deal could be different. You and your partner could do one deal together with 3 other partners, and then you could do another deal with 2 other partners, and it just makes a nice marriage. And we provide anything that you need. We make sure we have that.
Yes. So, all right. So let's talk to you about some of the actual capital raising strategies. So what do you think is the most effective strategy for raising capital?
Knowledge. Myself, when Dave has a property that he needs money raised for, I memorize that entire property. There isn't a question somebody out there can ask me I cannot give them the answer to, because the last thing you want to do is have somebody offering you $100,000, $200,000, which is hard-earned money for them, and I don't have the answers. Why would I even approach them if I don't have the answers? So I make sure I have every document, and I keep it on a thumb drive if I'm traveling, wherever I go. Kim Taylor always does our documents, and they're pristine, and we have a property package. We have all of her documents, the operating agreement, subscription agreement, etc., the PPMs. I keep them all on a thumb drive along with the wiring instructions. And then I bring the pages they need to sign along with me so that they don't have to go through and see how they can print it. They might be at an event or outdoors someplace. I bring those with me. And once we determine that they're interested and they want to put the money in, they do. But the package itself, the property package, can be anywhere from 20 to 30 pages long. I read that through maybe 2 times, and I take away key items that are really going to make somebody really want to be interested in what we're offering. And Dave's always been fair. He either does a 70-30 split or a 65-35 split. And the investors get the lion's share of the money. They get paid first before Dave and his partner would get paid. And I like that. It makes it easier for me, because if I say, oh, well, Dave's going to get this, but you're going to get that. No. So I always take Dave out of the equation, and I tell him the part of the deal that Dave gets, but then I concentrate on what they're going to get, because they really care about their part. And so don't I, because I'm an advocate for them. So that's how it starts. And we just go from there.
I love this from like a business development sales perspective, right? If we look at it from that lens, right? This is, you know, putting the human over the transaction, you know what I mean? Making sure that, you know, being prepared and really knowing and understanding your product, right? When you're doing sales or when you're doing business development is really important, right? Because then that the person on the other side, in this case, the investors, really feel that they can trust you. It's like this unconscious kind of thing that happens, you know?
Exactly.
And I think that, like, if there's something that you don't know, you know, like sometimes there's questions that I get asked on some of these calls with people that I don't know the answer to. I don't fumble. I'm just like, I actually don't know the answer to that, but I'm going to find out the answer and I'm going to get back to you as soon as I possibly can. You know, I think if we can just be honest and know as much as we possibly can about our product, and in this case, it's the investment, you know, and then have that, like, the investor up front, you know, before our own needs, then, you know, like that, it'll go a long way to develop a relationship. And whether or not the investor invests in our deal, they're always going to remember that interaction. They're going to remember how you made them feel in that. And
how
so
you made them feel
exactly
is critical. If they feel special, then you did your job.
Yeah. And they might not invest in this one, but then they'll be like, ooh, I remember Jeannie. And yeah, like I couldn't do the last one, but I can certainly do this one. And you don't even have to say anything because I already trust you.
Right. Right. It's true.
So what I'm hearing is, you know, from both your perspective, this is a little bit of a sales job. Okay. But it's mostly education. Right? You're mostly informing them. You're asking, hey, are you looking to invest in something right now? And if you are, let me tell you about this opportunity. The more knowledgeable you are about the opportunity, you know, what its metrics are, but also how the company's going to be run. What is the purpose of all these documents you're sending me, the PPM, the operating agreement, the subscription agreement? You've got to be able to explain that to your investors.
Exactly. These are required. We would be dead meat if we didn't have them. Kim would kill us.
You have an obligation when you're selling off interest in a company that's going to own something, whether it's a small business or a real estate, that you have an obligation to inform the investors sufficiently that they can make informed consent. That's a term of art, for SEC term of art. And so the way you do that is through private placement memorandum that discloses all the risks of the investment so they can understand whether or not that's a risk they can afford to take. And, you know, also what the financial qualifications are for them to be able to participate. That's in there. And then the operating agreement is the way that you're going to govern your company. It tells you all the rules of how you're going to run that company from the day you acquire that property until the day you sell it and dissolve the company and distribute all the proceeds. The subscription agreement is where the investors tell you about themselves and they certify to you, I am qualified to be in this deal. I do meet the financial qualifications that are required for this particular securities exemption. And they tell you what their past experience has been in investing. And you get to look at that and decide, does this person seem like they're suitable for the deal, given the other types of investors that are in the deal. And so you get to look at that and make sure that it's a good fit. So, you know, we're all part of the same team here,
Right.
you know, Ari
I
mentor.
can tell you a funny story. I had an investor who couldn't wait to give me his money. He couldn't wait. He kept saying, can I wire? Can I wire? I said, I don't have a single document from you. Do not wire. I will not take your money out of that wire until I have these documents, because I got to protect Dave, and, you know, I don't want to get into trouble myself.
Mhm.
Well, he did wire, and the wire was sent back to him. And he's saying, you sent me back my wire. And I'm like, you did not give me your documents. Oh, I forgot. I said, don't wire without those documents, because I'm not going to accept it. And Dave says to me, what happened to that $100,000? I said, I sent it back. What? I said, he didn't give me his documents. That's the honest to gosh truth.
Yeah,
Yep.
because they have to understand what they're getting into. And, you know, you really can't legally collect money before you've provided some appropriate documentation.
Right.
On, you know, what it is you're doing, and you know, so that requires really a consultation with someone like us, where we can help you figure out what documentation you need and then create it so that when that stuff is ready and you're presenting it, then you can go ahead and you've already got your bank account open, you're ready to collect the money in the right entity, you know, going to the right place. I've heard horror stories about many, I mean, not, and just recently, people who are like, well, I've already raised this much money and I don't have a single document, or, oh, I put it all into my bank. Put it
That
into
would be horrific.
this other bank account.
I
And
would
it's,
not take that.
know,
Yeah.
and they ask us, can you fix it? It's like, well, yeah, but you're going to have to offer everybody's money back and maybe wire it all back from them and start over. You know, and sometimes it's too late. Sometimes we can't fix it. And if somebody's already complained to a regulator, or they've complained, you know, to their attorney, hey, I gave this guy my money, I have no documentation. Well, you're likely to be sued for some kind of securities violation, or you know, by either the regulator or some investors counsel. So you've got to make sure that you're protecting yourself, and you're also protecting your investors, and the way to do that is to make sure they understand the
Not
deal.
to get off on the side, but here's how I'll do one package. So I always put the investors on the front of the folder and the day they wired, and I highlight them all in yellow, just so I know. And then in the backside of the folder, I put the operating agreement, subscription agreement, questionnaire, everything I got from Kim, including the property package that Dave would have created. And I staple that to the front. And then all the subscription pages and every document that has been signed by an investor is put in that same folder. And when that deal is closed out, I put a nice elastic band around it and I keep it in a file drawer until we sell that property. And then I put it in a Pendaflex folder outside. And we have a locked area here, and we've done 42 syndications, and there's 42 completed folders in there. So that if Dave ever got audited, I'm not going to make myself crazy. He's just going to go to that folder and he's going to take that to the bank with him. And they will see everything's in order. And he once, yeah, one of our coaches did get audited. And he said to me, what if you forgot something? I says, I didn't. What if you, I didn't. And he went to the court, and the guy said, I have an example of what's in all of these boxes. And the guy looked at it and he says, are they all like this? And he said, yes, sir. And he says, you're free to go.
Yeah.
And he went to the store and he bought all these pastries and he walked back and I'm like, you got back pretty quick. And he said, I gave him one of the folders and he liked it. I said, but where's all my work? And he's saying, oh, I left it. Oh, I could have killed him. But that's a true story.
Yeah, that's great. Yeah, and that is true because the exemptions, and when we talk about securities, you have an obligation to either get your offering registered, which means pre-approval by regulators. That's taking your company public. Takes too long for real estate. So the alternative is to qualify for an exemption from registration. And there are certain securities exemptions, but they each have a specific set of rules. They're all self-executing exemptions, which means you have to document how you followed the rules for that exemption, and you have to be able to produce that documentation if you're ever questioned by a regulator or questioned by opposing counsel in a discovery. You have to be able to produce that documentation to show how you followed the rules. So that's exactly what Jeannie's describing there is when you have the right documentation, if you get a letter from a regulator, you don't have to be afraid. You're like, oh, okay, sure. I'll come down. I'll bring the box of documents that I have, all the investors in this deal and all the documents they signed. That's what they're looking for. If you have that and you've complied with the rules, they're going to look through that and go, okay, this is not,
This is not a game.
this is not somebody. And even on a deal that went bad, that's what the private placement memorandum and the subscription agreement do for you is they help you because as long as you've warned the investors about all the things that could go wrong and that one of them happened, well, they were forewarned. They decided to assume that risk and they filled out their subscription agreement and said they could afford it and they were willing to do it anyway. So that's really how you have to look at it is that private placement memorandum, that subscription agreement, and the filings that we do with the SEC to notify them that you're claiming these exemptions, and with the states where your regulators or where your investors are from, that's what protects you. I mean, I remember another instance where somebody claimed, oh, I shouldn't have been in a deal. I was not sophisticated. And I think, the response was, well, here's all the, classes that this person has been through. And, the whole thing went away because they didn't have a substantial claim because they really were sophisticated. They could be in that deal. So you've got to make sure that, you don't want to take on investors who aren't sophisticated, that all they have are some savings and a job. They've never been to a real estate course. They've never owned real estate. They've never owned a small business. They haven't heavily invested in the stock market. They've never read a prospectus. Those aren't the people that you want. You want people, the opposite of that. People who've done some of those things. They don't have to do all of those things, but something to demonstrate that they're more than just savings and a job, innocent person who just, this is their only $50,000 they've ever raised. And if they lose it, they're financially devastated and they can't recover. So you don't want that. So
I have a little question here for you ladies. So for somebody that might use templates or not want to pay for the legal fees, like I on occasion will have conversations with people who are like, well, I've just used some templates, or I'm like, well, why didn't you hire an attorney for taking on investor money? Well, I just didn't want to pay the fees. What I mean, we've just explained the whole reason why you need to have that, but what would you say to somebody like that who might be like, nah, I think I can get away with it, I'll just get some templates, or I'll circumvent the having an actual securities attorney produce and review my documents?
So I am from Boston, and us Boston people are pretty direct. You are either going to pay before or you're definitely going to pay after. That's it. You want to take that gamble? Go right ahead. I'm not part of it. We have never, ever done a syndication without documents, everything. And everybody, I don't care if they can't write, they can use their toes. They are going to sign those papers.
Yeah. Thank you.
Yeah, it's, you don't want to be figuring out what's not in your documents after you've gotten the call from the regulator. And then the other thing, though, is that you also have to read and understand the documents that you have. You know, people come to us all the time and say, will you just review my documents? And, you know, our answer is it will cost you more to have us review your documents and figure out what's missing than it would for us to just draft them for you with the right provisions in them.
Mhm.
You know, we just this week, I've been working with a client who was in potential litigation with a management partner, that things were really, really escalating. And, you know, we were able to look at the documents and figure out, okay, this is what you can do to, you know, they were trying to sell a property and the person was just not cooperating and trying to demand more money. And we were able to look at all the documents, see this is what they're entitled to, this is what this is the only thing that they can get. And you know, it ended up and you know, not without some aggravation and stress, but it ended up working out. Finally, the person came to their senses and realized that they weren't going to get anywhere with their position, and the whole thing ended up moving forward. So, you know, the right documents can save you. Okay. The wrong documents can really put you in a bad position. I had somebody who had self-drafted their own documents at one point, and we actually used what they wrote to remove them from management. You know, because they weren't participating. And, you know, it's like, well, you wrote it, you know, sorry, you have to live with what you wrote. Anyway, so what kind of key financial metrics do real estate investors look for when they're thinking about doing a deal?
What financials do I look for when they're what?
What are the key metrics? Like, what do they want to know? Are they looking at cash on cash return, average annual return? You know, what is?
No, most people, it's pretty standard with us, but they want to know what the end date is. Most people want to know. They want to know how long they have to find something to either roll it into next time or to make sure they go from one to another so there's no hiccups in their lives. Now, ours are always syndications, so there is no, you know, way that we do, what are those loans called? Kim, I can't think. You know, when you can't use an IRA, or you can't use a 1031 because you can't roll it into another property. Ours has a beginning and an end, and then you take your money and you put it into another deal. But you can't just go from one deal and keep rolling your money into the next deal, because ours are syndications. Those other ones are like tenant in common, or not syndications.
So what Jeannie's talking about is with a 1031 exchange, if you individually are selling a property and you want to invest in another property, you have to have a deeded interest to that property. You can't buy LLC interest in somebody else's deal because it's not a like kind exchange. You're exchanging real property for personal property interests in an LLC. And so it's not interchangeable, and the IRS actually has some directives that specifically disallow partnership interests, which your interests in a syndicate are considered from being eligible for 1031 exchange. But that doesn't mean that if Dave wanted to, at the point that he goes to, you know, if he's the syndicator, if he goes to sell a property, that whole syndicate, he could take a vote of the members and say, hey, what if we just don't sell it? What if we exchange it for another property? If everybody wants to stay in the deal, or, you know, I think the rule is more than 50% stay in the deal, then you can move forward into another deal. What we really do is we just, you know, put everybody into the new deal and then re-syndicate the new deal, letting everybody that's coming in know that, hey, part of the reason that we're bringing in money is to pay out the investors that don't want to go forward, and also because it's a bigger deal. And so we're going to need more money to do what we need to do on that project. But that is a tremendous, tremendous tool for syndicators to learn. And that really deserves an entire podcast episode to talk about that.
It is also like a needle in a haystack to find that if you have 20 investors, that all 20 are going to want to move forward, because some may be retiring and just want to take their money and take their wives and go off to greener pastures, move, and, He'll be near the grandkids and just have a good time. So it's hard to ask somebody that when they're coming in, because they never know what's going to happen. They may lose a spouse and just are not interested later on. So we try not to mingle the two. If we do somebody with a 1031 and they can do the whole thing, no problem. We don't syndicate it. But if they can't do the whole thing and we've got to bring other investors in, they have to be liquid. They cannot come through any kind of IRA or equity trust or any of those people, because we can't promise that they're going to get out of that deal.
Well, and so I think that's true of a 1031, but it's not true of a syndicate. They can come into a syndicate. You can have self-directed IRA investors, but you can't invest in
Right.
you can't use your self-directed IRA to invest in your deal that you're part of the management of.
Right.
That's where
Right.
you get in trouble,
But
because
if you were going to move the money to another deal,
yeah,
you can't use
gotta have it
self-directed IRA.
comes back and then you turn around and
Yeah.
resubscribe a new deal, and that's always the cleanest way to get that done. So one of the key financial, the metrics that people want to know is what is the end date, but are they also, what are you telling them about returns? Are they looking at preferred returns? Are they looking at overall returns? What are...
In every case, we always offer a preferred rate of return to the investors first. And it might be a range, because maybe we're right now we see value adds that we're going to implement, but it might take 6 months to get there. So we tell them you may start out at 7, but within the first year you may go to 8, 8.5. But you rather underpromise and overdeliver than promise them something and say it's going to be 6 months to a year, and then on the 13th month it hasn't been completed, and then they're thinking that you're a schmuck because you didn't tell them the truth. You know what I mean? Sorry, I'm from Boston. I talk like this, and Dave's always politically correct. I'm not.
I love it. We need some truth.
I'm real. I'm
Yeah.
real is what I say.
It's
Yeah,
good.
I remember hearing from Dave at the first multifamily millions boot camp that I went to. And he said, if you have a problem at a property and you don't tell anybody about it, it's your problem. But if you tell everybody about it, it's everybody's problem.
Right.
And I've taken that to heart, and I've repeated that numerous times to that
Disclose
something is
always.
going wrong, talk about it now. If you're going to have to loan money to your project, talk about it with investors first. Give them the opportunity to make that loan. Maybe they want to. Maybe they have some money that they want to get that interest rate, or they want to negotiate an interest rate with you. And, you have to follow your documents to allow that. But if the documents allow it, then you're able to do that to get the money that you need. Otherwise, you may have to offer it pro rata to investors first as a capital call before you start loaning money. But the thing is, you've got to let them know what's happening and what the money is needed for, so they understand that there's a problem. Because if later on you can't fix that problem, or you run out of money and you've been loaning your own money to a deal, and all of a sudden it's like, well, you know what, we have to sell it and we're going to sell it short and you're not going to get all your money back. Sorry. Oh, and I'm going to get paid back all the money I loaned to the project first. That doesn't sit well with investors. So if they give you permission, not that you have to have it, but if you get their permission and say, look, here's what's going to happen. I can do this, but I am going to do this, and then I'm going to need to get paid that back before, when the whole thing sells. They have understood, they've agreed, they're not going to hold you at fault for that. But if you never told them there was even a problem, they're going to be wondering, what even gave you the authority to do that? Did you follow the docs? Did you do it the right way? And I've seen that situation. So
And I can honestly tell you, in all the years that we've been doing this multifamily business and bringing other investors in with us, not one capital call ever, because Dave would rather go to the bank, get his own money, put it in rather than burden the investors, because it might have been something that maybe somebody in the management team mistook, or they heard it, but they didn't really realize it. So never a capital call ever, which I'm pretty proud of.
But having a capital call isn't the end of the world, because again, you're also giving your investors an opportunity to get a return. And, maybe in some cases you want to offer them even a better return than they got on the original money. So, we've had some clients that have come up with some pretty creative ideas on how to handle those situations. And they've, what they imparted to me was a phone call to your investors explaining the situation one-on-one made all the difference in the world as to whether they got investors to participate. And so capital call isn't necessarily a bad thing. We make them voluntary. Okay, in the documents we write, we do not make them mandatory. So it's an opportunity for investors to raise their hand and say, yeah, I'll do that. I would like to do that, versus looking at it as a negative, where it's like, oh, y'all have to do this, and whoever doesn't do it, you're going to get penalized. A lot of investors won't invest at all if they see those mandatory capital call provisions in the documents.
Right.
So that, and what we've learned over the years is what really happens is a couple of people say, I'll do it, we'll do the whole thing. And then, the other people are like, I don't want to. Or you're able to make your case because you're really telling the story and explaining to investors the need, and everybody complies. So there's a lot of different ways it can be handled, but the right way to handle it is to inform people, let them know exactly what the situation is, what's happening, because, nobody could predict COVID. Nobody could predict eviction moratoriums, labor shortages, supply shortages, all the things that happened just a few years ago. No one could have predicted any of that. And, if a deal ended up, stalled or couldn't get the stuff done they needed to get done, weren't able to evict non-paying tenants, and then, kind of had some cash flow issues. Everybody understands that. We all heard about it on the news. We all understood that that was happening. So nobody's shocked that that's happening to them, as long as you've kept them informed of what's going on.
Luckily, we didn't have any issues with the COVID thing. One of our properties, and you know it well, Ridgewood, I mean, that property cash flowed the whole time. It was in such an upcoming area that it cash flowed in spite of COVID. But in the Katrina catastrophe, that's when we just sent notice out to all investors, and there was a lot of them. We had like 23 properties in one market. And we said, we're going to stop distributions. We are going to continue to do monthly calls, but there would be no distributions until this is all settled and over with. And you know what? People respected that.
Mm-hmm. That's right. And that was our advice to a lot of our clients at that time, was suspend distributions. You're not sure what's going to happen. And then at that time, the lenders started requiring all kinds of reserves and things like that. So, things changed, and it was just a unique situation, but doesn't mean it couldn't happen again. So Jeannie, are you okay to go a little long since we got started?
Oh yeah. And if you want me, you got me.
Okay.
I'm here now.
I want to summarize also what we were just talking about, just in three little phrases here. So one is underwriting, like know your numbers, know what you're getting into, right? But we can only know so much, right? Honest communication, like keeping that honest communication and working through whatever it is that you need to work through in order to have that ability to be able to communicate honestly. And the entrepreneurial pivot, right? Like having that entrepreneurial mindset, being able to pivot to look at the deal in a creative way, right? And then utilizing the experience, of Ari Mentor and of Kim and people like that who can help you like brainstorm and think of creative ways through any kind of issue that you might experience in the deal. That's what I picked up from that one.
And that's why you have a team, because there's no I in team. You all work together, you come up with solutions to make the best judgment for the investors, and keep it open. Let them understand.
Yeah.
Well, and then, so we talked about a preferred return, just in case anybody on the call doesn't know what that is. That just means that from cash flow, you're going to give the investors 100% of it until they get to a certain benchmark for the year, but you're going to determine that quarterly. So 8% has been the preferred return that has gotten investors to invest for decades. Okay. Any kind of deal, doesn't matter if it's small business, doesn't matter if it's real estate, 8% preferred return. They know at least, hey, at least I'm going to get 8. You know, it doesn't mean you have to pay it every single month, especially if it's a development project, but it could be accruing. So it's like, hey, we're not paying you for 6 months or maybe even 2 years if it's a development project, but during that period of time, well, we've had your money, you're going to get 8% for the first year, 8% for the second year, plus your money back when we go sell this. But it's not just the preferred return. So what you've also got to figure out is, what is our overall projected return for that project? And then how much of it do we need to give investors in order to get them the target return we want them to have, their cash on cash return or their average annual return? How do we get to that point? And what percentage of that deal do we have to give them? So I know Dave, some of Dave's books certainly explain that. So Dave, you know, the immersion, you're going to learn how to do that. At the Multifamily Millions, you're going to learn how to do that. But also in my book, so I've written 2 books on capital raising. You can get, if you don't already have a free copy that we've mailed to you, then you can get them at our website. They at syndication, sorry, in the wrong place. Syndication. Go to the free book tab and give us your address. We will actually mail you a physical copy. This particular one is the first one that I wrote, How to Legally Raise Private Money, Step-by-Step Guide to Syndication. This is in-depth version of it, so twice as long, more like an encyclopedia. Always say table of contents is your friend. That's what my contracts law professor used to say. But chapter 26, no, actually chapter 21 and 22 of this book actually talks about how to split money with investors, how to determine that, that split and what your overall returns are going to be, because it's not the preferred return. And we get a lot of clients that get confused about this. The preferred return is just kind of a carrot, but the big carrot is really, what are we going to give you when we sell the property in addition to what you got from cash flow? And if we take all that, add it all together, divide it by the number of years we've had the property, and then we divide your specific percentage of that by the amount of money that you invested, that's going to determine your average annual return. Some people use IRR, some people use average annual return. It's a little easier to explain.
We like the annual rate of return to be in the neighborhood of 20 and higher. And if you can do that, you got a good deal. I see some today coming out with 13 and 14, and I don't know how they're raising the money. I have no idea. But the bingo number is 20. Years ago, it used to be 22, 24, but today it's 20. If you're 19 and you have some value adds you're going to implement, and you're going to get to 20 before the end, that's okay. But if you're in the 15 or 14 range, you're going to have trouble raising money on a deal because people are sophisticated. They know.
Yeah, and we tell people mid to high teens is what investors are looking for as an average annual return. So if you go to our website and you want to make sure you get this book, it's going to ask you a question: have you raised capital before? If you say no, you're going to get this introductory book. If you say yes, then we'll send you this book. And also you can buy them on Amazon. Just look up my name, Kim Lisa Taylor, and you'll see both books, and then you can decide. This one's actually even on Audible and Kindle. This one we're getting ready to republish, the second edition. So we'll put that one on Audible when it's done. But that's, some tools for you to use if you're kind of newer to capital raising. So I think we have somebody who raised their hand. Let's
Yeah, it looks like it. William Edwards. Let's see. Should we allow to talk?
yeah.
Okay, William. Hi, William. You need to unmute yourself if you want to ask a question, or if you want to just chat. Okay, there you are.
Can you hear me now?
We can hear you.
So you mentioned the 20% project IRR is your magic number.
ARR, average rate of return.
Yeah, average.
How about in an opportunity zone investment?
Well, you know what? We don't really buy in opportunity zones right now unless they're halfway through. So you don't want to go into an opportunity zone and be the first guy out there that's starting this whole rehab. And I believe the government's doing the right thing by making better living for people, but you don't want to be the first one, because by the time you're halfway through, maybe the first couple that they did are already trashed by, the wrong clientele. So I would do an opportunity zone if they were at least a halfway through the whole proposition.
Can you still hear me now?
I hear you.
So you seem to be inferring that a building, this is a building that hasn't been built yet. This is
No,
just been
no.
entitled. There's just been entitled. Okay. But you
Oh,
seem to be
you're
inferring that.
talking about an unbuilt building?
Correct.
Oh.
Yeah.
We
Yeah.
don't buy
So-
that way. We don't do that kind of business, though. We don't do ground up construction. That's
Okay.
not Dave Lindahl's business. We buy existing construction.
Yeah, so they do value add.
Okay.
So
Okay.
buy existing and then value add, which really doesn't work for opportunity zones unless there is
Got
a
it.
opportunity, because you've got to be able to you've got to invest the same amount or more than the existing improved value of that project for it to qualify. So if you look at doing appraisal, land value is worth X, the building value is worth Y, then whatever that Y number is, you've got to invest that much more. So if you're just rehabbing a project, you're not going to get there. If there's an opportunity to construct another building, then you might.
Got it.
So that's that. And on the development projects, what I recommend for people doing deals in opportunity zones is that you actually need to have two classes of members. One who are cash paying investors, not trying to take advantage of having reinvesting the proceeds from a different eligible project, because those investors could be cashed out on a refinance. They could be cashed out at any time, but your investors that are actually trying to take advantage of the tax deferral benefits are going to have to stay in that deal from the period of time,
At least 10 years.
10 years. And so you don't necessarily want to tie them all up together. And if you separate them by classes, then you have some better opportunities for long-term holds on those projects. So thanks, William. That's a great question. Do we have any other questions, Krisha?
Hang on a minute. I think I need to remove William here. I'm going to remove him from here. Hopefully it doesn't remove him from the whole thing. Let's see. Peter Lopez said, I assume that in order to stop distributions, it must be disclosed on the documents and approved by all investors. Is this assumption correct?
No,
No.
not really, because you never know when something's going to happen. You could be going clip-clopping along, everybody's getting cash flow checks, and then you have a Katrina catastrophe or a COVID. So how are you going to know? You can't see into the future. So you stop distribution when the property is in danger. People are moving out, moving home to be near their families because they're scared to be in an apartment without family around. Maybe their parents are getting older. They want to move home and help them. So no.
Yeah, no, and the way that we structure these deals, so a properly structured syndicate is going to be using a manager managed LLC. And the manager is a separate entity that's just composed of the people who are, their loan sponsors, people who are raising the capital, people who are going to be asset managing that deal, overseeing property managers. and managing those investors long term, that's your asset management team. It's a separate LLC. So the investment entity is manager managed, and the manager makes all those decisions. And one of the decisions that the manager gets to make is whether or not there is distributable cash. You don't ever tell people that we pay distributions quarterly. You tell them that we evaluate distributions quarterly, because maybe for the first 6 months there are no distributions because you're putting the money that you're generating from cash flow back into the property and doing the improvements that are needed, or some event happens that you need to suspend the distributions. But the manager determines distributable cash, and distributable cash is the cash that's left over after paying all the operating expenses of the property and after paying off the debt service, and then looking at what's coming up and withholding sufficient capital and reserves for tax payments, whatever is coming in the future, capital improvements, etc. Then you make a declaration. The management team makes a declaration. There will be a distribution. It's going to be this much. And then you distribute it according to the waterfall in your operating agreement that allows for those things. So Joe raised his hand.
Yeah, it's gone now.
Joe, if you want to talk, you go ahead and raise your hand again. Any other questions in the chat?
Let's see. I don't see any questions. Just Bill Brancucci said no to answer the last
Yeah.
question.
No, he's answering the questions that
He's
they're
answering the
asking.
questions.
And I think that's pretty cool, Bill. You're pretty engaged.
Yeah.
All right. Bill Brancucci, let's promote Bill to a panelist here for a minute, if you can.
Let me see if I can find him. Oh, here he is. Okay, allow to talk.
Hey, Bill.
Bill, you're here if you want to mute. There you go.
All
Thanks
right.
for being on, Bill. So
Hey,
Bill,
all.
I want to introduce him. Bill is a RE Mentor student. He went through their programs.
Yeah.
I met him, through some people that had gone through that program as well. He's been a very long-term client of our firm, but he's also been a podcast guest of ours 2 different times. I highly, highly recommend that you listen to those podcast episodes with Bill Brancucci, because he's been out there in the trenches. And I saw these guys go from doing $3 to $5 million deals in 6 years. They graduated up to doing $30 to $50 million deals. So if that's something you want to know about, you want to catch that episode.
And I'm grateful to Jeannie and you, Kim, for all your guidance. Because we started with nothing. And the one thing I would just tell any newbie coming in to definitely do it, but over trying to make money is partner with the right people, because most people have never raised a penny. And it's uncomfortable. You're going to ask a friend for 50 grand and he's going to start looking at you funny. And it's going to change your friendship. It's now a business relationship. Doesn't mean you shouldn't do it, but I've met a lot of people that have never asked anyone to invest. And it would be better to partner, in my opinion, with 2 other sponsors that have done it and watch them do it. Hopefully they've been trained by you, Jeannie, and Kim, using your documents and guidance, because there's a million pitfalls. No matter how smart you are, no one knew COVID was coming. No one knew that evictions were going to be much, much harder after COVID. Unless you knew something everyone else did, there's a lot of things can go wrong. And you just want to be with some veterans that say, I've seen this, or this, you always want to be ready. So our first deal, we partnered with 3 other syndicators, probably overkill, but we wanted to make sure we could raise enough money to close the deal. And we took less than we should have, but it was better to get the experience. Really important. I don't know if that helps.
No, that helps a
Very
lot.
much so.
Yeah, also Bill had made some comments that only went to us as the host and the panelists, but I want to share them with everyone. His recommendation on client or investor communications was I recommend emailing a quarterly newsletter and a phone call. Those are always by investors. They want to ask questions from a live human being. So I think that's
They found, I have found even if it's bad news, they respect you for saying, I'm glad you called. I want to ask you a question. 9 times out of 10, it's put to bed. But if you hide behind an email too much, they feel like disconnected from you. And when you bring them in, say you're our partner, you may have them for life.
That's right. I
Now
mean, what I do with our investors, I give them every way to reach me. They can reach me by my cell phone, by my house number, by my work number, by email. Any way they need me, they can reach me. And that gives people comfort.
Mhm.
It makes them feel comfortable that somebody's going to advocate for them. Whatever the little thing it is, it might be something silly like, can I change my subscription name? And we send them new documents and they fill them out and we just change the name for them. But, you know, they just are confused and they want a voice to talk to.
Oh, someone had asked, is there another way to get the book? So it's from one of our books. You can text the word syndicate to our main phone number, which is 844-796-3428, which also spells 844 syndic, SYNDIC, and the number 8. So 844-796-3428. Text the word syndicate to that, and a form will pop up on your phone where you can give us your physical mailing address, because we're mailing you a physical copy. And then somebody said, I wish your voices could be on Audible. The one currently is not as nice as you guys. Well, that's nice for you to say that. We're gonna do that on the next one that's coming up. Anyway, Bill also had another comment that he had put into the chat. So remember, your biggest investor is your lender. Pay out all cash to the point where it's hurting the property, you can expect them to intervene. The lender is at the front of the cash flow. In fact, not even just that consideration, also the LLC acts of every single state say you cannot make a distribution if it would bankrupt the company. And if you do, then you as a member are obligated to give it back. So, you know, you don't want to ask people for money back, so you just don't make the distribution, and you call them, you have a meeting, you send out your letter explaining what's going on, and you tell them why. But just a little something that came up earlier this week when I was helping someone resolve a potential litigation issue was, we said, we want to leave the door open for them to call, right, for a phone call. Because if the parties can actually get on the phone and talk, it is likely they will resolve the issues. If you continue to fight over text, text fights or email, fights, you're likely not to. In fact, there were some law school student studies where, certain students were only allowed to talk electronically and other students were allowed to pick up the phone. And they found overwhelmingly that the ones that could call and talk to each other were much more likely to resolve the issues than the ones that only could communicate electronically, and those issues escalated. So the human voice is hugely important. Zoom calls, if you can get on them, you can often resolve a lot of issues, but you just want to be careful about how you communicate. Thanks a lot, Bill. Thanks for being on today.
Yeah, that was really nice, Bill. Thank you.
My pleasure.
All right. Well, we could interview Jeannie for hours and hours, of course, but her time is super valuable. She is an RE mentor coach. If you love Jeannie and you want to, learn more from her, then you might consider, joining the coaching program with RE Mentor and asking to see if Jeannie can be your coach. But I will tell you that there are also a lot of other coaches there that are very excellent at what they do.
Yeah, we have over a dozen coaches and they really do a good job. Don and Craig have been coaching since 2005. Long time.
You've been there for a very long time. If you do come to the private money event, then you'll meet Jermaine. He's also a coach and a snappy dresser, I will mention.
That's true.
All right. So thank you so much, Jeannie, for stepping in.
It's my pleasure.
Thank you.
Thank you for having me.